Hey there, I'm Mike, the founder of Financeable, and today we're going to take a look at a tricky investment banking interview question that, in my experience, about 90% of prospective investment banking analyst candidates will get wrong. And in particular, this question focuses on the concept of enterprise value. And this question is designed to trick you based on the traditional way that enterprise value is taught as the equity plus debt minus cash formula. And I'm going to show you how to avoid the traps here and also how to build root level understanding that will just allow you to navigate any variant of these types of questions. So with that said, let's jump in here. So to kick things off here, I'm going to walk through the interview question prompt, which is we have a company with $100 of enterprise value, and it has a 50-50 mix of debt and equity at the time of the original funding. And then the business has accumulated $10 of cash in its bank account. And then we're going to further imagine that from one day to the next, the business generates $1 of cash flow. And the question here is, how does that impact enterprise value? And now to walk through this, I'm going to show you two different ways you can answer this question. So I'm going to pull up the bits and pieces here. And we're going to start with the standard finance way of working through this. So to begin with, we're going to imagine again that we have this $100 business. So it's $100. Slide that over to the center. Make it a little easier. And then we're going to put in debt of 50 and equity of 50. And we're going to scroll down a little bit here. We'll imagine the business has, in addition to the equity in the business, that it has $10 of cash. So the equity value here is $60. And the question here is, if the business were to generate an extra $1 of cash flow, what's going to happen to the enterprise value of this business? Now, I want to start with the traditional finance approach here and just show you the mechanics of what's happening, and then show you an easier way to answer this question. So to walk through this step by step, I'm going to zoom in down here. And when we look at the situation, if we generate an extra $1 of cash flow, what's happening here is the $10 is going to become 11. But our equity value is going to go from 60 to 61. And because the equity and the cash both go up, when we subtract cash, we're subtracting one more from a $1 higher equity value when we worked enterprise value. So if we take out the cash here and we are left with equity and then we add debt, we're going to end up with an enterprise value of 100. So the answer is that the enterprise value doesn't change by virtue of the cash being generated, just mechanically. But just even looking at what I just explained, it's kind of confusing. And if you have to work through this on the fly when you're stressed out in interviews, I would argue this is probably not the optimal way to do it. And it's also why I really push back on really internalizing the concept of enterprise value as this formula of equity plus debt minus cash. It's not wrong. It's just a really tough way to maneuver through this, particularly in an interview and also really on the job. So just to be clear here, and just to lay all this out, we're starting with EV. We subtract out debt, we then get to the equity, and then if we have cash, that's also additive to our equity value, which is really just the owner's value. And then if we start down at equity value, we would subtract out the cash. We would then be left with the leftover equity. We add the debt because there's only equity value because there's value beyond the debt, and then we get back to enterprise value. So that set of mechanics isn't incorrect by any means, but if you're trying to get to the root of what's happening here and why this question is being asked, people ask this question because it confuses you because you're trying to work through the mechanics the way the formula is taught. The way I think about that formula, by the way, is that formula is a bridge, which is actually often the term that's used internationally. It's the EV bridge. It's the bridge from the value of the business to the owner's value and then back again if you want to go the other direction. It's not really the formula for enterprise value. The formula for enterprise value is what is the price you'd pay for the right to all the future cash flows of the business? That's really the root of enterprise value. Now, if we move over to the right-hand side here, the way that I would encourage you to really think about this for interviews and ultimately be able to navigate these questions much more easily is we're going to, instead of thinking about a business, we're going to look at a house. And you probably don't think of your house as a business, but if you step out of your house and you rent it out to someone, that house is a business. It's an asset that's sitting inside of a container, or if you just own it, it's yours, it's your container, or it could be a corporate entity, but it's an asset sitting inside of a container that generates dollars. And the operating asset inside of this, instead of it being like a company, a big business, this is my best company here, almost looks like the house, but a big business, instead of it being a big business, What we're looking at here is the operating assets aren't a business with a headquarters and employees and so on. It's simply a house, which is a cash flow generating asset. So a house is a business is a house. Now, with all that said, I want to go back and revisit our question here, but instead of framing it through the lens of the traditional formula, I want you to think about a house. And the question is, if I owned a house that was worth $100, I made a down payment of half the purchase price of $50 and I funded the other half, and then I rent it out for a year, and I accumulate $10 of earnings in my bank account after profit. And then the next day I generate an extra dollar of profit from renting out the house. Would the value of the house change? And in particular, the way this is usually framed, it seems like it's going down. In particular, would the value of the house go down? And the obvious answer is no. If I rent out my house, the value of my house doesn't go down. That doesn't make any sense. And the reason I'm pointing this out is if you think about it in real life terms, and if you equate enterprise value to the value of a house, it's just much easier to work through mentally, and there's no benefit with going the other direction and using the whole formula. And so, in short, when you're working through enterprise value, the way I would think about this is the house analogy here. We'll imagine this is our house. We'll just use a box. And if you're thinking about a business or a house or a business, it's the same thing. The $100 purchase price, either way, is enterprise value. When you buy a house, by the way, it's $100 enterprise value. It's the same exact concept. You're paying for the total purchase price of a cash flow producing asset that is substantively enterprise value, and it's a function of the price you're paying for the future cash flow rights. If you fund it with 50-50 debt and equity, and you usually would set up a bank account if it's a rental property, the value of the house is the value of the house. The value to you is the value after the debt, inclusive of any cash that is in the bank account, because as the owner, that's your money. And if we wanted to go the other direction, we could. But the big point I want to make here is that if you frame this in your head as a house, at least for me and virtually everyone I've ever worked with, it's just much easier to think through these problems and think through, okay, well, if I have a $100 house, and you don't even have to go through the math, you just say, okay, well, if I rented out my house, would the value of my house change? Well, no, the owner's value changes, the value attributable to me in my bank account changes, but the value of the house is still the value of the house. And so hopefully that makes a little bit more sense now, and hopefully you have a tool in your tool belt to navigate tricky problems like this. This is something we focus a lot on in the courses, is really getting past the formulas and showing you all the bits and pieces and making these things easier. And so if you found this helpful, I'd highly recommend checking out some of our other content at finance-able.com or financeable.com. With that all said, I will see you soon.